Hey folks, welcome back to Harvesting Income. Today I'm going to talk about an interesting fund that I came across, last year. This is SPYT, and this is known as the Defiance S&P 500 Income Target ETF. These are ETFs which are basically targeting to, provide a certain level of income, which is not guaranteed. Like in this fund, they are basically trying to achieve a 20% return, and they build a strategy in such a way that they can generate that 20% return. So how do they do that? Like that's an interesting question, and that's something we will discover. And I'm just going to go through the fund and the details and see how they are able to do this magic, strategy that will help you, uh, generate 20% return. Before we go ahead, just a quick disclaimer: this is not an investment recommendation. I'm not a licensed financial advisor, and whatever we are discussing is just for the knowledge purpose, and the returns or the details that we are discussing is something which can change dramatically over a period of time. So just keep that in mind. So let's look at the basic features of the fund. Okay, SPYT is the ticker, and that is defines 500 income target ETF. And let's go down further to know what is the strategy, how it works. Basically, the strategy says it's an actively managed ETF, and basically it generates current income. So the idea is to generate higher level of income, and it revolves around holding shares of ETFs that track the S&P for performance. That's the first part. And engaging in the selling of daily credit call spreads on the index. Okay, the second part is little different from a regular covered call ETF that we discussed recently. Like a lot of funds do the covered call strategy. This strategy is somewhat similar to that. However, there is a minor twist because, just like other funds, this fund also invests in the same S&P 500. But instead of having the shares of the S&P 500 index, like instead of buying the individual components of the index, they are basically buying another ETF, which is similar to the S&P 500 composition. So instead of buying the individual stocks, they are just trying to buy the index ETF directly, so that they can get direct index exposure on their holdings. And the second part, they are trying to sell daily credit spreads, basically daily credit call spreads. Basically, the call spreads would mean selling one call and buying another call. I'll explain that later as we move ahead. That's the whole idea they are using, and using that they are able to provide enhanced potential yield, by buying one call option at a higher strike price and selling another call option uh, at a lower price. So that's giving them this enhanced kind of yield. And here they say, SPYD's investment approach is meticulously designed to generate income through option premiums derived from selling the index call spreads, the primary driver of the fund's yield. So that's going to be the main source of income for the fund. And we sell at or near the money call spreads to retain the upside growth, and aim for a target annual income of 20%. Okay, so they are giving more color here. When they are selling the option, they are selling at the money or near the current market level. So that gives you a good opportunity to harvest more premiums. And they buy another option at a higher level, at a higher price. Obviously, that second option which they are buying will be at a cheaper price. So sell one option at a higher price and buy another option at a lower price. When I say price, it's the premium. So the difference in the premium is going to generate that income for the fund. So that's how their trading strategy works. So each day the SPYT sells credit card spreads on the S&P 500. Interesting. And prioritizing option with near-term expiration. And as I explained, this entails selling the call options at the money or near the money strike prices, and buying call options above that strike price. So should the S&P 500 value rise above the strike price, SPYT stands to profit from further upside appreciation in the index value. So this is how this fund is designed, and it is a little safer than the regular covered call because it's able to lock in that profit. But there is no guarantees here. Okay, the NAV is 1928, closing price is 1929, and they have net assets of about 93 million. So that's how the fund has been doing. This is a fairly new fund, and it's not a very big size. It's a decent size, and it was launched back in March 2024. And yeah, so that's the basic information about the fund. Let's go down further and look at the dividends. Yeah, you can see the holdings. Before we go to dividends, let's look at the holdings of the fund. Almost like 100% of the holdings is into IVV, which is the iShares Core S&P 500 ETF. Okay, I discussed about one a boring ETF in one of my previous videos, which was a buy right ETF. But this is actually the plain index ETF, which is not even a covered call ETF. It's just a plain index ETF, tracks the S&P 500 index, and this is from iShares. So they basically hold this exchange traded fund 156722. That's the quantity, and that's the market value. 93 million approximately is the market value. And they also invest in the government, you know, government securities fund, which is around 481,000. Okay, now when you look down here, this is where they have mentioned about the calls. Like they are selling. Okay, in this case, they are selling one call, which is the 594247 call at 1307, and they are buying this call 595435 at 802. So the difference in price about roughly about $5 is what they are capturing in terms of the income. We will come to this detail a bit later, but let's quickly look at the dividends of the fund. As we go further down, you have the dividends here. Okay, fund was launched back in March 2024, so basically we have like around 9 months of data, 9 or 10 months of data. So here you can see like every month, like right from March, the amount of dividend is roughly around 33 or 34 cents. 34, 32, 33, again 33, again 33 cents, and goes on like that. So roughly it is in the 32 to 34 cent range, which is very tight range. So I can say that it's pretty consistent based on the past history. Like in future this could go up and down, but based on the history it looks like the fund is pretty consistent in terms of the dividend payouts. So looks like even the call spreads or the strategy is giving you a kind of predictable, I would say, but um, which is predictable and kind of consistent kind of payout that you're getting. Like, so for someone looking for a consistent flow of income like every month, this would be a great fund to look at. Uh, when I try to look at the dividend yield, like I just try to look at the dividend yield. Like I put this in the spreadsheet and I did the math. I'll just show you that part of it. Here, the price is 1929 as of the date of recording, like around January 3rd. And when I look at the previous months, like the dividends are in this range. I try to calculate, take an average of the dividends because we have only about 10 months of data. I took an average. So, average monthly dividend is about 33 cents. So, 33 cents times 12 will be the annual yield. So that would be roughly around 3.6 or $3.6 or $4 around that range. So when i when I do the calculation of the yield, like 33 cents times 12 divided by the price, I get about roughly 20.7%. Yeah, it's 20% as they claimed. And we have to see at the end of 1 year, like once they complete 12 months, probably another 2 months, we'll have to wait and see if this is going to be, consistent. Like it could be 20, it could be probably slightly higher, 21. We never know. Like, so I also tried to do another scenario. Like, what if the fund is able to only do the minimum dividend? Like, I took the minimum of the 10 months dividend, and minimum is like 32 cents. Like if you are making just 32 cents, like worst case scenario, I mean assuming the same trend continues, we are still looking at 20.1. Like, so we are still in that 20% range. Like, so keeping taxes, expenses, etc., other costs aside, like from the fund itself we are making around 20%, which is a good return. And mind you that this is made in all kinds of markets, like whether the markets go up or down, you're still able to lock in that price, and the lock in that spread between the two calls that have been executed. The other question that rises is like, this is something difficult to answer for me at this stage. Like, will this sustain? Like, will the fund be able to do this every day and make that lock in that 20% gains for me? I don't know the answer. Like, it is possible theoretically, yes, it's possible, but practically, how it works or what happens, what are the challenges. I'm not a trader, or I'm not a professional to advise on the practical aspect. But if someone knows about it, or if you have more information on that, please drop in the comments, or your views on this subject. Like, it'll be helpful for all of us. Okay, now I will go back to the quickly go back to the trading example, and then go back to the two call options that they are trading. Or one option is being sold and the other option is being purchased. So net net, there is a premium which is being logged in terms of gains. So let's see how it works. So um so just keep this in mind. Like, they have purchased a call option of 95942. Let's leave the fraction, and they have sold the call option at 5942, 5942, and they have purchased a call option as 5954. So I will quickly show you this, both of these simultaneously, so you can relate to it. Okay, so if we just look at this example, the short call, basically the call which is sold is at 5942, and the long call, the call which is purchased, is at 5954. So obviously, for this call which has been sold, which is at the current market level or near the current market level, is the premium is about $13.07. And for the other call which has been purchased, the premium is $8 roughly, 8.02, $8.02. So net net, they are making about $5 between these two. Okay, now I'll expand the sheet to give you a bigger, better view here. Okay, let me go step by step again, just to reinforce what I explained to you. So there are two transactions. One is the short call, which means the call which has been sold, and the other one is the long call. So the short call has been sold at this price, 5942. I'm just putting in bold, and at a price of 13.07. So for selling this call, they earned a premium of 1307, and they sold 185 contracts. So they didn't sell just one call; they sold 185 calls, and each call is like 100 shares. So 185 times 100, so 18,500 is the total quantity of shares we are talking about. And and based on that 18,500, if you multiply by the premium, it's 241,795 total. That's the total amount which is being earned, or the option has been written and premium has been earned by the fund. So basically, I have put this in a plus sign, because it is like a inflow of cash into the fund's account, because it's a profit made by the fund by selling the calls. And the second part of the transaction is the long call. The fund purchased the call at 5954, at a slightly higher level, and the premium they paid for it, the fund is paying premium in this case, so it's an expense. So I just put it in a negative number, um, just to make it easier. And if you multiply that 8.02 by the same number of contracts, we have the same number of contracts sold as well as purchased. So doing that, we get 148,370. So when we try to calculate the net premium, like net profit loss, it comes to 93,425, which is basically 241,795 minus the 148,370, which is used for buying the calls. So on one side you're selling calls, on the other side you're buying calls. So net net you made 93,425, and we have outstanding shares at 4.8 million, which I input from the other window, and I have the price at 1929. So total market cap is about around 93 million, roughly 93,074,250, And when I do the math like on this, so on this total fund it's making about 93,000 per day. So I did the rough math. This could be incorrect, and this is not a investment recommendation. Just a quick disclaimer: this is not a recommendation. So you can double check these data or points, or you can also consult with a professional before you make any decision. So this is my own rough calculation, or you can call it speculation. So I am based on the 20 days in a month. I have just done this calculation. So number of trading days in a month can vary. So what I've done is I have divided net premium divided by the market cap to get the returns. But this return is only for one day. Like it's basically return per day. Return per day, it could be in some decimal number. So I multiplied that by 20 to get the return for roughly 1 month, assuming roughly 20 days in a month are the trading days when the stock exchanges are open. So based on that, I'm getting roughly close to 2% as the monthly return. So keeping that as a rough estimate, like on an annual basis, you can look at something like a 24% annual returns. And this is just the estimates. So there could be other things like trading costs, fees, and a lot of other factors which can reduce the returns a little bit. And there could be other factors, probably some months the premiums may be less, or the premiums may be lower, or the spread between the premium may be low. So returns could be lower as well. So on a gross level, like gross basis, you're getting about 24% returns. But net it could be different. It could be somewhere close to the 20% that the fund is targeting. So that's the target return that we are achieving in this fund. Um, it looks reasonable to me. Like let me look at the fund's dividends. Like dividends, we have already seen that it's pretty consistent. Like it's very you know consistent, not varying so much, like just a few cents up and down, like 1 cent or 2 cents up and down. So based on the dividend flow, it seems to be achievable. But let us also look at the price, how the price has been performing for the fund, like whether the fund value came down or up, or how did it perform up to now, like for the last 10 months. Just go back to the other screen. Okay, we don't have the 1 year performance. So let me check the okay, up to 6 months they have made about 6.82%. This is the capital appreciation part of it. Okay, let us look at the chart so we can get a better idea. Let's look at the stock price chart or the fund price chart on the Google. Okay, okay, it started at close to $20, like 1996. Now it's 1929, roughly 3.36%. Okay, so not much of a concern here. Like probably it has dropped a little bit in terms of the price, but that's not a big worry. And this also provides a good opportunity for people to buy at a lower price. For someone looking to buy close to 19 or 1920, 1930, this is a good opportunity to buy the fund and get a slightly higher yield. But overall, I don't see any issue with the price erosion or nav erosion. So overall the fund is performing well. And I would also say that this is a good fund for people looking for that target return, and also someone looking to get steady income flow from the S&P 500. So it's like investing in the S&P 500, getting that target return, and using that extra dividends or your income. You can either reinvest back in the fund to increase your dividends, or you can invest in other ETFs, other funds, or wherever you want to invest. You can go for that. And this is also good for more conservative investors who want to get that steady flow of income or the yield. And yeah, this is a pretty interesting fund to consider. And probably I'll try to do a deep dive once it completes 1 year. And there is another fund which I want to quickly mention before we close off, and because it's interesting, I came across this recently in one of the other videos by a few other YouTube finance experts. Like this is the XPay, which is from the Roundhill Investments. SPYT is from Defiance, but this is from Roundhill. And this is also working in a similar fashion, target 20 distribution ETF. I haven't gone through the full details of this ETF, but it looks somewhat similar. This was launched pretty recent, like, let me double check when it was launched. This was October 31st. So we just have like couple of months or 3 months data so far. So it's too early to make any assessment of this fund. And I can see this fund is having about 6.66 to 7 million roughly in terms of assets, and expense ratio 0.49. And when I compare it with the Defiance, expense ratio is 0.94. Defiance is a bit expensive on the expense ratio front. That's one difference I can see here, and here it is 0.49. So this is a kind of cheaper in terms of cost. I have to study the strategy. I've not gone through it. Like it is kind of seems to be similar, but I'm not too sure about that. And NAV has been pretty stable. So this is another fund which is interesting. You can look at. The name is XPay, and this is from Roundhill Investments. And yeah, I will put a link to another video of another channel like which explains about this fund. But this is a pretty new fund, like that's something you need to keep in mind before you make any investments. But I would say that SPYT has some track record, and also has delivered consistent dividend yield. So this is something which you can consider for future if you're looking to start afresh, or you want to look at a fund that provides you a consistent amount of dividends or a set target returns. This is something you can consider. And thanks a lot for watching. And please feel to share your comments, and feel free to subscribe to this channel. Thank you.